Okay, this one's number 4, and we're continuing with some things about risks and models and so forth. And last one we ended up with a couple of truths, I called them. Well, so we'll call them truths here too, but we put them in quotes because they're not always true. But anyway, the first one was that firms should not diversify. Not diversify. And the reason is that stockholders and owners of the shareholders can just do it much more cheaply. So now there is a case, of course, where the firm could do it more cheaply than their shareholders. For example, maybe they could buy a firm or where there's no public market or maybe nothing similar to it. But never underestimate the robustness of the capital markets that we have these days. So most of the firms that were the so-called horizontal firms that had all sorts of companies that weren't related, the parts were definitely greater than the whole, and when they broke them up and sold them, that was proven. So almost no contraries to that one. The other one is that value is created on the left-hand side of the balance sheet, meaning that firms should be dealing with their assets, creating them, developing products and all that sort of thing, and then financing then just became a cost. So here with financing, there was just a cost to it, and you had to make a judgment. If it was too expensive, then you didn't do the project. But the idea is financing was a cost. However, about a year ago, or maybe even before that, we had the big liquidity crisis. Now, it's a big problem. In fact, a lot of projects that were really good and NPV greater than 0 at any reasonable financing cost just couldn't get financed because the market's all frozen up. So I think the best way to think of that is that financing, maybe instead of a cost, let's make it a constraint. But if you build the right kind of models, which is what this is all about anyway, is that you can still simulate these projects and what kind of cash flows they'll bring into the future. And if you can't finance them, well, then you can't finance them. Maybe you can't do them, but at least you can look at the viability of the product, and when the liquidity crisis ends, you can go ahead and get them done. So something to keep in mind. So we'll start now with number 3. Book values and sunk costs don't count. Seems pretty strong, doesn't it? They don't count. Now you might say, boy, that's an extreme thing. But the point of it is that that's what people pay for things. If you have a business and you buy an asset, and then you create a product and sell it, the people that buy it from you could care less what you spent for it. It's really what can it generate in the future. So the only thing that really economically is important is what's going to happen in the future, not what you paid for something. So when you say, well, this company, you look at a balance sheet and you see a book value and you say, well, they're selling for 1.5 times book and so forth, that really is a poor way to look at things. Now, granted, sometimes it can give you some insights because you can compare it to a lot of other people in the industry, but they're book values. That's not any kind of economic value. Economic value is what you could sell it for now, or what the value of that cash flow stream in the future is worth. Fourth thing I'd like to mention here is that we're going to create some analytic models, valuation models. So I'm going to, and these models give answers similar to those you find from a capital market. I've done it for years. Lots of people have done it. And you build these models and you find that they can give you very good answers, and the way you check it out is you value publicly traded companies and so forth. So you get a lot of confidence in these kinds of models. And if they work in the capital markets, then you can say, look, I'll just extend my belief, if you will, and they will then work for, say, divisions, business units or private firms. And by the way, these models work for banks, insurance companies, service firms, manufacturing firms, and so forth. I think most people building models thinking of manufacturing firms, but they work for the service firms and the financial firms just as well. Now, I don't know if this is number 5 exactly, but the theory we're all working with is that you can, any company that you want to model or value, you can find in the capital markets either a security or group of securities that will give you the same cash flows and risk of the entity that you're dealing with. Now, that might be a very strong assumption, but always in the back of your mind remember the whole reason you think this thing can work is because there's something in the capital markets where you could put together a set of cash flows and risks by grouping some securities that would give you exactly the situation you have. Now, is that possible? Probably not. But you can come close enough to it that it can give you some reasonable answers. And remember, we're not talking about 1% accuracy here for these valuation models. For really, 5 and 10% is probably just very well. Now, one point I want to make right here is, and I guess maybe we could call this one number 6, it's management's role. The role is to increase the wealth of owners. And I'm going to say right now, that's it. Now you're going to come at me very quickly and say, oh, no. There's lots of other things you have to worry about. What about the other stakeholders? People worry a lot about them. And say, that's management's role to worry about these and so forth, and so the owners are just another stakeholder. No, they're not. And I think I can just very simply show you. Let's look at the stakeholders. What are you talking about? Employees. You're also talking about customers. Talking about the environment. How about the debt holders? The debtors. Okay, let me move up just a hair here. Now, if you look at these stakeholders, and then you look at the owners, you have to realize that to do this, to increase this wealth, it's going to take time, and the owners are first in with the dollars, so they give the money. So managers are going to take these dollars and create something, but it's over time. And how can you create wealth over time if you don't take care of these folks? You have to. If you don't take care of these folks, then you're never going to create any wealth for the owners. So it's a totally consistent thing. And you'll hear a lot of people say, those greedy owners are just the management just trying to take care of the owners and so forth and so on. And, they're screwing the employees or whatever. No. They have to take care of the employees. And if you don't, the owners will never get their cash back. Okay, we're running out of time, but we're just about ready to talk about net present value and value creation.